Hello everyone. Today we're going to do chapter 13, Risk Return in the Security Market Line. This follows from chapter 12, where you learned one of the measures of risk, which is to measure standard deviation using historical data. In this chapter, we will provide a more formal relationship between risk and return. In other words, we will show you how to measure risk, and then specifically we're going to say, if you have this much risk or you estimate this instrument to have so much risk, then you should demand so-and-so return. And you can already know it that the higher the risk, the more you'll demand. But this will come up with a model to show you exactly how much extra to demand as the risk goes up. So we start first with learning to estimate the expected return in standard individual stocks and portfolios using probabilities. So this is more forward-looking as opposed to what you learned in the previous chapter. Then we need to bring in the concept of portfolio diversification, because we'll show you that that individual risk is different when you are considering them as held in a portfolio. This then will lead to what we call the difference between systemic and unsystematic risk. So it's not systemic, it's systematic risk. And then from there, we'll describe that model, which I talked about. It's called the capital asset pricing model, and from which we derive the security market line. So the first thing we're going to do is to do what we did in the other class, learn how to calculate the standard deviation using the second formula. So for that, let me just refresh your memory. In the first example, when we did a formula to measure standard deviation, we said standard deviation is equal to the square root of sigma, and let's say Ri is the return, minus return bar squared, n minus 1. But the alternative way, the forward-looking way, is to something similar, except sigma, I running from 1 to n, we just multiplied by pi, the probability number, minus what we call the expected R, and that square root of that. Sounds very difficult, but it's not. Again, as I told you, don't be intimidated by formulas. Exactly, we'll break this formula down just like we did the other one down at that point. So the example we're going to do is as follows. First, we're going to look and study how to get the expected return. Okay? Remember, that's required in the formula. So let's take two stocks. Okay, we take two stocks, and this is what we predict will happen in the future. So there's a 50% chance that next year there'll be a recession, and 50% chance there's a boom. Now, this is a very simplified model. Of course, in the real world, you'll be making much more finer probability estimates. Recession, boom, normal, deep recession, or very high boom, etc. like that. Let's make it very simple. And then given that, we start studying stock L and stock U. And here's what we come up with. When there's a recession, we think stock L will get a negative 20% return. So if your stock was selling at 100, it'll probably sell at about $80 right now. On the other hand, if the economy takes off, then this stock is going to do really well. It may even go up as high as 70%. So if you had a stock worth $100, then it's probably going to end up being $170. Stock U, on the other hand, in fact, when there is a recession, it turns out that this stock actually has a 30% positive return. And when there's a boom, it's only going to be a 10% return. So this is a kind of stock which we call counter-cyclical stock. It does well when the economy is not doing well, and it does poorly when the economy is doing well. Some examples you ask, I say, well, think about the gambling industry, for example. Chances are gambling industry might do well during recessions and not so well when the economy is in a boom. Others have cited real estate. That is, when the economy is not doing well, money flows into the real estate. But in these days, we find very little of those kinds of clearly defined counter-cyclical stock. It's all over the place these days. At one time, it used to be thought of as gold was a counter-cyclical stock, so that when economy went into a recession, people put all their money in gold. But again, recent studies have demonstrated that this is not necessarily the case. But for our purposes, let's assume that this is the actual return that we have predicted. Now, how do you get the expected return of this? Well, remember, the arithmetic we do is very simple. We took summed up all the numbers and we divided by 4. But here it's different because here we have probability numbers. So in this case, what we say is that the expected return is equal to the sum of PI RI. So that it's a probability times the return plus probability times the return plus probability times the return. In our stock example, stock L, if you recall, was the one that had a minus 20% and a plus 70%. And we gave it a 50% probability. So 0.50 times 0.10 is equal to minus 0.10. 0.50 times 70 is plus 35. So that equals 0.25. So we say on average, if you were talking to grandmother, you'd say on average, I expect a return of 25%, since the estimates are varying quite high for the boom period and low for the recession period. Similarly, stock U, 0.50 or 0.13 is 0.15, and 0.50 of 10 is 0.05. So it's 0.20%. So the expected return for stock L is about 25%. In other words, if the stock is $100 right now, you'll probably get 125 at the end of the year. If you had a risk-free rate, so for example, one of your opportunities is to either put in a bank or invest in a government bond, let's say the government bond because it's the safest, and it's giving 8%. Now what we're saying is if you invest in the stock, you may take a risk, but the risk premium you may bear is about 17%. It's 25% minus 8%. So that's called the risk premium. Because you can always put it in a government bond and absolutely be safe. So if you do take the risk and invest in a corporate bond like L, then the chances are you might be rewarded with a 17% premium over and above the risk-free rate. And with stock U, it's about 12%. Okay. Now, using this information, let's try to solve for the standard deviation of both these two stocks at this point. So there are two ways to do it, and usually I prefer the other way because we have the correlation measure, but I might as well stick to the way the book is done. And in the book, we follow the same rules as before. So let me refresh your memory. So the formula, as I told you, is R is equal to square root of sigma pi Ri minus R bar squared. We've got the R bar squared, expected R. So the probability is 50-50. Here's Ri. Ri was minus 20, right? So minus 20 minus 0.25, that was the expected return for stock L. So minus 0.20 minus 0.25 is minus 0.45. The other likely return is 0.70. So Ri minus R bar is 0.45. So that took care of this term here. Now we need to square it. So we'll square 0.45, 0.45, and we'll end up getting 0.2025, 0.2025. So we've taken care of this part now. We've squared it. Now we're going to multiply it by pi. So 0.50 times 0.2025 is 0.10125. 0.50 times 0.2025 is 0.10125. And if we sum it up here, that's going to equal to your variance. But if you took the square root of that, that becomes the standard deviation. So if you take the standard deviation, it'll be 0.45 or 45%. Similarly, we're going to do it with stock U. Remember, stock U's expected return was 0.20. So first we take 0.30 minus 0.20, 0.10 minus 0.20. So this is equal to plus 10, and this will equal to negative 10 right there. Then we square it, becomes 0.01, 0.01. Then we multiply it by the probability. 0.50 times 0.01 is 0.05. Both of them. We add them up, take the square root, and lo and presto, it's 10% at this point. So we have a standard deviation of 45 and a standard deviation of 10% at this point. So let me just go back to my sheet. So with stock L, we had an expected return of 25%. Stock U, we had an expected return of 20%. When we calculated the standard deviation, it was 0.45, and this was 0.10. So based on what you have, what we are saying is, or telling grandmother is, on average, we expect a 25% return. 2 standard deviation of that is 0.90. So with 95% confidence, we could say that her stock can go up as high as 115%. I'll put percentages here. Or it could go as low as, subtract 25 from 90, so it would be negative 0.65. Okay, that's negative 0.65. Let me just double check. 0.25 minus 0.9, 0.65. In this particular stock, grandmother can expect to get, of course, a 0.20%. 2 times standard deviation is 0.20, so it could go up as high as 0.40, or it could go up as low as 2. So if she had a stock of 100, probably reach 120, but it could go up as high as 140, or it could just remain as 100. Whereas this stock, I'm going to lower this for a moment. This stock, I can say on average expect to get about 125, but it can go up as high as 215, or it could come down crashing to about 35 bucks, 65% loss. So obviously we know which is the most volatile stock. This is obviously more volatile, as shown by the standard deviation, can range, a difference of 180% up down, whereas this one is only a 40% up down on that. So step 1 for this chapter, trying to estimate the standard deviation of individual stocks looking forward, it's not a problem. The problem, however, does come when we have more than one stocks in a portfolio. So as long as you have one stocks or above in a portfolio, in a sample of stocks, then we call that a portfolio. Okay, so for example, You decide, I got $1,000, I'll put 500 in stock L and 500 in stock U. Well, what grandmother walks to the room and says, what's your probability of return now? Well, doing it the long way is very simple, right? We have 50% of the stock, of which 50% is going to earn 20, and 50% of it is going to earn 30. So this is -10, plus 15, so it's about 5% at this point. So what we are saying is that, let me put in red, 50% of my stock is only going to earn 5%. The other one has a high of 70 and 10 with a mean of 40, because 50% of it will earn 70%, that's 35. 50% of it will earn 10%, that's 5, so it's 30. So 40% is what my other portfolio will earn, multiplied by 50 means 0.20. So on average, if I hold a portfolio, I basically expect to earn about 22.5%, which kind of makes sense, right? Because if you hold this portfolio, expected return is about 40. If you hold this stock, it's expected return of 5. That's 45% in total, but it's 50-50. So on average, you can expect to earn a return of 22.5%. Now, what about variance or the standard deviation of this stock? So let me go back up here now. So we said stock L has an expected return, 25%. Stock U has an expected return of 25%. If I buy 50% of it and 50% of this, then essentially what I'm doing, I'm sorry, this is 20. What I'm doing is I'm going to get a perfectly weighted average, which is 12.5% here, 10% here, so it's 22.50%, just like we calculated over here in the previous page, right? Now, what about the standard deviation? The standard deviation of L was 45. Standard deviation of U was 10%. Can we say if we hold 50 and 50, it'll be 55, therefore it'll be 27.5%. Just like we did with the mean. Just take 50% each. And therefore, if this is very risky, this is not risky, it'll somewhere lie in between that. Unfortunately, that is not true. And to show you why that is not true, I'm going to do a very simple example and see if you can follow me on this example. I'm going to make up as I go along, but it should be pretty clear what it is. Suppose there are two stocks and I decide to also hold them in lots of 50-50. So this is a portfolio, 50A and 50B. Let's say you decide to own both stocks at a percentage of 50-50. Let's take a look at stock A. Suppose in the first year, you make a 10% stock return, or the stock earns a 10% return. But your stock B earns about 40% return. So now let's see, if you hold both stocks in 50 and 50, 0.10, 50 in 0.40, that means 20 and 5, on average, you should get a 0.25% return, correct? So let's put it as 0.25. Now let's say the following year, the economy tumbles. and this thing comes to a -5%. This one also tumbles, but it only comes down to +25%. Okay, no, wait, sorry. No, that's not it. This one actually goes the other way and goes up to about 55%. So one stock went up, one stock came down. So what's the combined effort? So the combined effort is 50% of my stock has earned a -5% return, but the other 50 did a 55%. So that's 27.5 minus 2.5, turns out I'm still at 25%. So in year one, when one stock went up flying, another came down, my portfolio continued to remain at 25%. Let's say in year three, we see a huge boom, and this stock just shoots up to about 45%. Guess what happens to this stock? This stock comes down crashing to a -10%. But what happens to a portfolio in period two? In period two, let's see, 50% of it did whopping 45%, but the other 50%, let me be careful, this is not exactly turning out, sorry, 55%. And the other one turned out to be -10%. So that's 27.5. Sorry, I need to recheck here. Sorry, this should be 55%, right? It went up a whopping 55%. That's 60. So let's say, sorry, it went up to 60%. I know it's not looking very good, but you'll get the picture shortly. So it went up whopping 60%. So that means this thing is plus 30, this is -5. Guess what? The portfolio continues to give a 25% return. Let's say the following year, in period 3, sorry, it'll be period 4 now, because this is already 3. Boom, this thing comes crashing down to about +20%. This thing goes up a whopping up to 0.30%. What's the average? This is giving me 20, and this is giving me 30. That's 10 plus 15. Guess what? My portfolio remains at 25%. Actually, this is period 1, but we've done it 3 times. So what's the trick here, folks? How is it possible that these two stocks fluctuate so wildly, but when I mix them together, I get a steady 25% return? I'm sure some of you have already guessed it. And what is the right answer? The answer is these are perfectly synchronous, but in the opposite direction. When my stock went from 10% to -5, how many points did I drop? I dropped 15%. What did I do here? I showed 40% went up 15%. Next year, when this stocks went up from -5 to 60, that's a 65% increase. Guess what happened here? I dropped from 55 to -10, which is a -65% drop. And finally, when this stock went from 60 to 20, that's a 40% drop. I went from negative 10 to 30, a 40% up. So we had a perfect negative correlation of -1. You can rarely find stocks like that. But it is possible that if you have a correlation of 1 of a stock, then your standard deviation will basically be 0. So because you can see right here, I have no risk. They move so perfectly asynchronous in the opposite direction, that is synchronously in the opposite direction, that I have no risk at all. This would be wonderful to have in a portfolio. You want 25% return, 0 risk. But of course, so why am I showing you this? I'm showing you this because when you're trying to find the standard deviation of 2 stocks, where one is fluctuating like this and another is fluctuating like this, we don't know what the until we know how they are correlated. Do they move together or do they move opposite to each other? For example, if I bought a stock C, let me see if I can reduce it down here. So if I bought a stock C, oops, same problem. If I bought a stock C, and another stock, and it also did just like stock A, there would be no reduction in risk. So the trick is to buy stocks that have negative reduction. Now, that's not going to be the case because in the real world, these days, given the total integration of markets globally, more and more of the stocks are headed towards, positive territory. We use this notation for correlation. But the correlations are in the 0.40 to 0.60 positive range, okay? In the old days, we would say international stocks used to be not that correlated. For example, when the US was in a recession, the chances are UK would be in a boom, or Asia would be in a boom, or the other way around. If the US was in a boom, other countries might be in a recession. But these days, as markets get more and more integrated, you're beginning to find less and less negative correlated stocks. And most of them tend to be moving in the same directions. But having said that, there are still opportunities to diversify. That's why when we talk about your portfolio, that you should invest in your retirement fund, for example, it's a good idea to mix it so that the correlations are not that perfect. And that's why we tell you to hold some international stock, some utility stocks, some revenue stocks, etc. Because one of the benefits is that they're not correlate perfectly at that point. So that means when I go back to this problem, if I know one stock's volatility is 45, another stock's volatility is 10, when I mix them and say, what if I hold 50 and 50? Well, I don't know what it will be unless I know how they move each other. So one of the formulas for calculating the standard deviation of a portfolio, so this is standard deviation of a portfolio, is to know what the correlation coefficient is between the stocks. But the example that we use in your textbook is a slightly longer method, so you don't have to do that in that respect, because what we do in the textbook method that's used is as follows. It uses the same formula that we did. That is, we use just this only without the correlation formula, minus R bar squared. But what we do for this R is we use the portfolio R from the previous chapter, from this example. Because we said, if you hold 50 of this and 50 of this, sorry, it's over here, 50 and 50, then your return is going to be a 5%. for stock L and 40 because it's taken already the average of the two. So in that case, you say, all right, let me find out what my RI minus R bar is. Well, the RI you use is already the portfolio RI. This is 50% of L, 50% of U, 50% of L, 50% of U. Then you take the mean. So the mean of this is, as you know, is 22.5. So I subtract it from a 22.5. And what do I get? 5% minus 22.5 is going to be actually negative 0.75. Keep missing out these negative numbers. When I square them, I get it as 0.3065. This one is 40% minus 22.5, still 17.5, but positive. Square it, multiply it by pi, sum it up, take the square root, and lo and presto, you get 17.5%. So portfolio consisting of 50 and 50 of L, 50 of U, has an average return of 25.5 and a standard deviation of 17.5. So individually, stock L, the return, the standard deviation was, return was point, geez, I already forget. Return was 0.25. Return was 0.25. Standard deviation was 0.40. U return was 20, standard deviation of 10. But LU, which is a portfolio of 50 and 50, the mean is 22.5 in between these two. But the standard deviation is 17.5. More towards the L side, not 20%, the one in the middle. Oh, sorry, 25, but 17.5. And that's because they are correlated, but not fully. In fact, in one of the things, they're negatively correlated. Because remember, when the stock went up 70%, the other one went down negative 20%. Okay, so that's the first part of this chapter, how to calculate the standard deviation using the forward-looking formula, and then how to calculate the mean and standard deviation of a portfolio of stocks. Mutual funds, for example, have over 500 stocks in their mutual funds. So the mean will just be a weighted average of all of those returns. But the standard deviation, it's a very messy formula, but in the same principle as what you did. And then we'll see that these will be the results. If you looked at two stocks, and if the stock is perfectly correlated, then there'll be no reduction of risk. If it's perfectly negatively correlated, then it's possible to have a volatility reduced to zero. There's a one combination of stocks which will bring it to zero. And if there's no correlation between the stocks, there is some reduction in risk. Because remember, when you say correlation between two stocks is zero, it means both of them move randomly. But the volatility will still come up down, because when you do the formula, you'll see when you divide by n, it will come down by a little at this point. Okay, let me quickly do one example from your book. Assume a portfolio consists of 50% of stock A, 25% of stock B, and 25% of stock C. So now you have three different stocks. The expected returns of the individual stocks and the portfolio, it should be, and the probability is given below. Let me change this. Why am I writing this down? I'll give it below. Let's say there's a chance next year that there will be a 40% chance it'll be a boom and a 60% chance there'll be a recession. Look at what stock A does. 10, 8, 15, 4, 20, and 0. First, let's find the mean. So the mean of the portfolio is as follows. 50% of it will earn 10, 25% of it will earn 15, 25% of it will turn 10. So the mean is going to be 3.75 if there is a boom. On the other hand, if there's a recession, this stock will earn 8%, so it'll be 50% of 8. The stock has come to 4, 25% of 4. This stock is 0, so 25% 0. So we expect the mean to be about 5%. So the expected return on this portfolio also. So we have this and this. Okay. Now we can calculate the expected return because we said there's a 40% chance it'll be a boom. And since we have a portfolio, that will generate a 13.75 return. There's a 60% chance there'll be a recession. There's a recession, a total portfolio may 5%. So the mean of the portfolio is 8.5%. Now we do the standard stuff. You do the formula, just to refresh you again. Sigma pi Ri minus R bar squared. So let's calculate first Ri minus R bar. Here is Ri. We said the expected return is 13.75. Expected return is 5%. I subtract the mean, 8.5, so minus 8.5 minus 8.5 equals 5.25 and 3.5. This will be negative 3.5. Square it, I get this. Multiplied by P, this one gets multiplied by 0.40. This one gets multiplied by 0.60. I get this number. I sum it up. It's right here. And then I take the square root of it. And lo and presto, I have the average return on my portfolio is about 8.5%. And my standard deviation is 4.949%. So you know it's easy to do. So the mechanical part is over for this first section. Okay. Now, I told you early in the beginning of the class that now I'm going to come out and show you a very neat way of relating the risk to return. In other words, if you knew what the risk was, you should know what you should be able to demand on the return. So I'm just showing my face again at this point. So, but moving on. Before we do that, we have to discuss about exactly what do we mean by risk. We said volatility, but in this chapter you're going to learn it's just more than volatility. So when we said, grandmother, you should on average expect a 25%, on average expect a 5%, just remember that's an expected return, okay? But what is going to happen in the real world is that in the real world, your return is going to be some expected return, plus, of course, it may go up or minus, because you cannot be perfectly correct all that. As by definition, it's an expected return. So we can write total return as going to be what we expect based on our probability model, and then we call U as a component where it will be up and down by a certain percentage. Okay, so, and that's because the probability at least will give you some expected return number. So early on, we learned that the market's efficient and all prices are impounded in the price of the stock, and especially if a lot of analysts are following the stock, the only reason the stock price will move is if new information arrives, correct? We discussed that. So announcements information that comes in, therefore, also made up of the expected part and unexpected part, or the surprise part. What we are now going to focus now is on the surprise and unexpected part that surrounds the expected return. So in order to do that, let's now focus on the surprise part. The surprise of part of uncertainty is the risk to that this is made up of two components. So if I took randomly a bunch of stocks, so if let's say there are about 3,000 stocks in the New York Stock Exchange, I take 30 stocks there and I measure each risk. So first, I take one stock and I measure the standard deviation. Then I have two stocks and I measure the standard deviation of the portfolio. Then I take three stocks and measure the standard deviation, and four stocks, etc. What I notice is that as I add the numbers, on this axis is the number of stocks and on this axis is the risk. It turns out that I continue to lower my risk as I add on more and more stocks, roughly around 30 stocks randomly selected. I can do it multiple times. But after I select 30 stocks, I see that my risk tapers off, or the volatility tapers off as measured by the standard deviation. So what we know now is that therefore that gives us an ability to break down risk into two components. One is called the diversifiable risk, and one is called the non-diversifiable risk. So the non-diversifiable risk is a risk that every stock is affected. And it could be things like GDP, interest rates, macroeconomic conditions, business cycle, etc. So those are the non-diversifiable risk. Okay. The others obviously are diversifiable because it seems that when you add more and more to your stock, your portfolio risk comes down at this point. So let's move on. The diversifiable or unsystematic risk components refers to the idiosyncrasies of individual stocks. So for example, if I had 30 stocks, there's a good chance that one of the stock or two of the stock firms will have strikes or work stoppages. That means that stock price will come down. But another stock probably might have a discovery of a new product. The third stock just saw a CEO being fired. A fourth stock saw positive news because one of the competitors ended up with an accident. So as we see, these are unexpected events, so these should be random. Okay, the ups and downs should negate each other. So on average, therefore, this particular risk it averages out to zero because of positive news and negative news. But what it also means is that we don't have to pay for that because the average is zero. The undiversifiable risk, on the other hand, is the same for all firms. And as I mentioned, GDP growth, inflation rate, global recession. This has important implications because what we want to show you now is this, that you have to be aware when you buy a stock that you should be pricing only one kind of risk, okay? And let me explain that more as a David and Goliath story. Suppose you wanted to buy 1,000 shares of IBM. At the same time, I'm sure many mutual funds is also going to end up 1,000 shares of IBM. Now, why do I call it a David and Goliath story? I say that because if I'm only buying one IBM stock, then I'm, of course, let's say, calculate my standard deviation, and it turns out to be 15%. But there's a mutual fund that is also buying IBM stock. And what happens is they have a whole basket of stocks, IBM, Exxon, Google, Intel, Bank of America, whole bunch of stocks. Now, what did we learn from this graph here? That as you add on more and more stocks, your diversifiable risk is taken away. So the David and Goliath story comes about this. When they calculate the risk of the IBM same, so this is my calculation of IBM stock, right? So this is my calculation of IBM stock. But a mutual fund, when they calculate an IBM stock return, it could be turn out 10 because they don't have to worry about the diversifiable risk. In your stock, you have taken into account that there could be a strike, there could be a CO firing, etc. So I'm going to price that in my estimate of the standard deviation. So what's going to happen, folks? The fact is that let's say you say, okay, standard deviation 15, I should pay $60 for the stock. But the mutual fund, which has the same stock, will say, what? Oh, that's not as risky as this, so I'll be willing to pay, 70 for it because it's a little less risk. So guess what? You will always be priced out of the market. Because the mutual funds, the same stock when they calculate it when held in a portfolio will have a lower risk and therefore will be willing to pay more for the stock. So the moral of the story therefore is, as an individual, you should always price the stock as if it is held in a portfolio. You're not able to do it otherwise. Sorry, this was supposed to be red. So the rule is, if you want to price a stock and you want to buy an individual stock, you better calculate it as if it's held in a portfolio. Otherwise, Goliath is always going to beat you when it comes to the price. So you cannot measure the total return of the stock, which consists of systematic and non-systematic risk, or diversifiable and undiversifiable. You should only be talking about the diversifiable risk. So then, of course, you're going to ask me, all right, I think I get the picture. How do you measure this thing called systematic risk? Well, it turns out that that's the measure we use in finance all the time. That measure is called the beta of the stock. So we're going to now learn how to calculate the beta of the stock, which essentially is a measure of only the systematic risk of the stock. So it only measures or is a risk associated with only systematic risk, not unsystematic risk or diversifiable risk. So let's see how we'll do that. And for that, I'm going to do another example in your in the Word file here. Let me make sure I have clicked it here. Oops, wow. Got all kinds of bugs coming in. The window is open. So let me press that down. All right, so let's see how to do this. Let me try and explain again as if I'm explaining to grandmother. You want to come out with a measure of systematic risk. And you don't want it to include unsystematic or diversifiable risk because you know that we have to price this risk as if held in a portfolio. And when you hold it in a portfolio, your diversifiable risk goes away. So what you're left with then is just measuring what we call market risk, which is common to all the stocks. Let me give you an example here. So you want to know how to measure the risk of a stock that is only susceptible to movements in the market. Let's say I do an example. I take an IBM stock, and this is what I notice with the IBM stock. I notice that every time, let's say the Dow Jones, or we'll call it the S&P 500, so it's a market portfolio of 500 stocks. Every time the market goes up by 10%, I notice that IBM stock goes up 5%. Every time the market goes up 20%, IBM stock goes up 10%. Every time the market goes up 30%, IBM stock goes up 15%. Every time the market goes up 40%, IBM stock goes up 20%. Okay, not correctly drawn. So let me ask you, if I were to say how sensitive is IBM stock relative to the market of 500 stocks, what will you say? You'll obviously say, it seems to be, it always goes half the amount as the market. And when we go into negative territory, it'll be the same. So that's exactly what we want. What we end up coming out with the measure, because you take the slope of this line, that's the beta of the slope, is half, 0.05. So then what we say is the beta of IBM is 0.5, because it seems to be half as volatile as the market. When the market goes up 10, it goes up 5. When the market goes up 20, it goes up 10, 30, 15. Let's take another stock. Let's say this is Chevron. Now that's risky. But let's say whenever the market goes up 10, you notice that IBM goes up 20. When it goes up 20 points, you notice Chevron goes up 40 points. When it goes up 30, it goes up 60 points. So obviously, and this goes downwards too at this point. So what can you say is the volatility or risk of this stock relative to the market? You say it's twice as risky. So when we calculate the slope of this line, the beta will be 2. So Chevron, the beta is 2 or twice as risky as the stock, as the market portfolio, whereas IBM is 0.5. So there are various ways to measure the beta. Companies use mostly this formula, but they add on certain, and they fine tune it a little bit. For example, Reuters and Yahoo Finance, this is some of the numbers that I got from previous and of today. We saw in 2012, Microsoft's beta was 1.01, but in November 2016, it was 1.39. IBM, on the other hand, has always remained a low risk portfolio, 0.67 and 0.76. Walmart is also very low, 0.35 and 0.09. Apple, much as it's a valued stock, has been quite risky, above 1, 1.22 and 1.55. AIG during the crisis was having a very bad time, although it was 3 years after the crisis, but still not fully recovered because they're being bailed out by the government. So its beta was 3.14, but now it has stabilized and the beta is 1.4 at this point. So that's how we measure stress. Now, the good news about betas is that we can mix and match betas with different stocks. So let's rehash a little bit. When we did earlier, we studied how to measure risk. We said, let's calculate the standard deviation. So this is the standard. But now we also said we know how to measure the beta of a stock, which only looks at market risk or unsystematic risk. So let's take two stocks. Let's say we take stock C, which has a 20% standard deviation and a security 30%. Now that's total risk because it includes systematic plus unsystematic risk. But when we measure the beta, it turns out that security C actually has a higher beta than security K. Now how is that explainable? how we explain is this, that a security C, for example, has a lower standard risk, but a high systematic risk. So in other words, even though individually it doesn't have a high risk, it moves with the market a lot more and higher than the market, as opposed to security K, which on its own has a 30% risk, but when put in a pool of 100 into a bundle of stocks, it moves less than the average of the market portfolio. So that's why it's very important that we price based on beta and not on because we have to know how it is related to the movement in the general market as such. Also, if we have two stocks, let's say ExxonMobil has a beta 1.4, Coke has a beta 0.52, the good news is you can mix and match, and that is a simple weighted arithmetic average that we get. Okay. Now, so let's rehash for this chapter. We learned how to calculate the standard deviation using the probability numbers. But then we said, you know what? This measures total risk. It is not appropriate to use total risk because the big guy or the big person will always beat the small person. So if you want to buy a stock and you want to measure risk first, you have to use beta, which measures the systematic risk. The systematic risk of the stock. Okay. Next, we said the beta. I mean, there's a few other side things like the beta can be weighted average, etc. But I know what you're going to say. But you're saying, okay, I think I know how to measure the risk of a stock. But tell me now, how do I get exactly what should I demand once I know the beta of the stock? And so here is where we come to the capital asset pricing model. Okay, and so based on the security asset pricing model, we're going to derive the security market line. And that basically gives us a formal relation between risk and return. Okay. So I just want to make sure it was still recording. Okay. Now, having said that, when it comes to studying from the textbook, I would like you to realize that I'm only going to do a very little part of the security market line. So when you go to chapter 13, I would say when it comes to 13.7 on page 430, just skip that and just focus on my notes at all till it comes to about the page 436. So between 430 and 436, you don't have to do all the derivation because really that's not for a class like this. We don't need the formal proofs or the capital market line to begin with. We're just going straight to the security market line, okay? And now I'm going to explain to you how a security market line, and so this is one of the formulas you learn. The security market line is given as follows: RF plus beta expected RM minus RF. Again, looks very intimidating, but you shouldn't be. It's very straightforward. And the way I'm going to explain to you is like a short story to grandmother. I mean, it's a story related to grandmother, okay? And once you get that, I'm hoping you'll understand this formula very well. So let's start. Let's say grandmother has about $750,000. And guess what? She lived through the Depression, so she doesn't trust any bank at all. And so guess where she keeps the money? Yes, she keeps it under the mattress. Now you recently found out, so you basically are getting totally worried and saying this is ridiculous. So you're going to say, grandmother, this is ridiculous. There have been 2 fires in the neighborhood. We had a few burglaries down the neighborhood. This is not going to work. And then you explain to her that, look, she can put this money in a bank. Well, oh no, she doesn't trust banks. So she can buy instead government bonds. It's the government bonds. They are backed by the U.S. government. They have never defaulted. And they have the highest rating on these bonds. And so it should be absolutely safe. And therefore, and plus she'll earn a certain rate of return. So let's say the current risk-free rate is 5%. I'm just making up a number. Let me just make sure I get the numbers same to what is the 5% and 50. Okay. So 5%. So finally she agrees, and she takes the money out of the mattress and buys government bonds. And guess what? She's earning 5% happily away. After some time, and I kind of joke and I say, grandmother's hitting 89, you're thinking about your inheritance and say, grandmother, this is ridiculous. You're barely making 5%. You can easily put money in a mutual fund. There's some big ones like Vanguard, Fidelity, etc., that will put into a bunch of stocks. And you know, when you have a portfolio of stocks, it moves just with systematic risk, and hence it's pretty safe, but you'll get a much higher return. So grandmother says, how much is it going to be? She said, this time I expect the return. So the return, ERM is the expected return on the market, is around 15% per annum. And then since you know the compounding value with future value, that can really increase the final return in a couple of years. So in other words, if grandmother was to move in from the riskless asset into a risky but portfolio, then she's obviously going to earn 10% more, because it's 0.15 times 0.05 means she will earn 10% more. And we call this term expected as the market risk premium. And to define that, it means that she's moving out of the risk-free to the risky portfolio, but a well-balanced portfolio. So it gives the market risk premium is 10%, meaning to go from risk-free to market, you'll get 10% more. So let's expect, and remember the market portfolio, the beta is actually 1. So now if grandmother goes in there, she should make 5% plus 10%, 15%, which is exactly the return on the market. Guess what? My grandmother moves into the market, and now she's happily watching the Vanguard returns every few months. And guess what happens then? You walk into the room one day, and what is she doing? She's reading the Wall Street Journal. And she turns around to you and says, you know what? I'm thinking about you. I would like you to have a very large inheritance. And I heard about this stock, and it's a great stock. That stock has a beta of 2. And I heard that if you have a beta of 2, I could even make as high as 25%. And you go, how's that? Well, she says, look, if I follow this security market line formula, if I go to the market, I get 10% more. But if I invest in a stock that's twice as volatile as the market, then I'll get twice the risk premium. So then it'll be 0.05 plus, I'm sorry, this is 0.05. twice the 10%. So boom, I'll make a whopping 25% instead of this measly 15% by putting all my money in Vanguard. So obviously, what are you going to say? You're going to say, that's great, grandmother, but hey, you do realize that when beta is 2, that means it's it's twice as volatile as the market. Instead, why don't you put some of your money in IBM? And what's the story with the return on IBM? Well, return on IBM is it'll be 0.05, but wait a minute, it's half as risky as the market, it's 0.5, so I will only get 10%, but it is half as risky as the market. So if I invest in the market, that the market beta is 1, I get a 15% return. If I invest in a stock that is twice as risky as the market, I make 0.25. And if I invest half as risky as the market, then I get 0.10. So that's this formula, security market line. It's a very simple and elegant formula. It's a linear model. It basically says, listen, if you're investing, your one opportunity is always to invest in a risk-free. If you want to increase your risk, you can go into a market portfolio. And then if you want to double your risk or triple your risk, then invest it in D beta, that is 3 times or 2 times. But if you are even wary of the market and you want to invest in really safe stock, then invest in stocks with beta less than 1. So beta less than 1 would be very safe stocks. Beta greater than 1 would obviously be riskier than the market. So that's it. It's a very straightforward model used extensively in industry, modified, of course, from the basic model. And I like to show it to you in the form of a graph. So let's say this is beta and this is the return. The security market line can be drawn like this. This is called the security market line. And how does it show? Well, here it is. If it's a beta of 1, we said the return, or the required return, what you should demand is 15%. If a stock's beta is 2, then we calculated it as 25%. If you invest in a stock with half of the beta, which is half as risky, then you should get only 10%. 5 and 5. 5 for the risk-free plus 5 for the premium. Let me go back to my notes. I hope that was able to explain to you the risk-free rate. Okay. Now, let's do a simple example. So let me start with a simple one here using the same formula. Let's say you had a base stock with a beta of 3. How much should you demand for investing in such a risky stock? So you should say, no problem, I can use the formula. Let's say the stock is, I'm just picking on Chevron. So it'll be 0.05 plus 3. The expected return on the market is 15.05. So it's 0.05 plus 3 times. This is 10 times 3. So I should demand 30% premium for 35%. So if a beta is 3, I should demand 35% return. Now what we are going to do, and that's not in your book, but it's a very simple example that I'm going to do, and say, okay, how do you decide when to buy a stock and when not to buy a stock? Okay. So we'll start with one example here. I'm going to redraw this diagram again. So let me come down here. Remember, the intercept is the risk-free rate. When beta is 0, which is like a government bond, you should at least earn 5%. Now, let me give you an example and say, listen, you plan to buy a stock with a beta of 2. It is currently trading at $100. You expect to receive a dividend of $5 and plan to sell the stock at the year of the end for $115. Should you buy it? So it's a beta of 2, correct? So you say, all right, I know from Finance 203 that if there is a stock with the beta of 2, and if the current risk-free rate is 5, beta is 2, market is 15, 0.10, then, I'm sorry, 0.05, then plus 20, I should demand a 20% return. So I should earn 25% return. Let me put it in. Now let's see what information we have. The cost of the stock is currently, so that's P0, is $100. It is expected to sell at $115 and a dividend of $5. So D1 is $5, and we can sell the stock at the end of the year at $115. Now recall how we measured the return. So this is the required return. This is what you should demand. What can I expect with this information? What is my expected return going to be? So my expected return is, remember, new minus old overall, or so I will make $115 plus 5, and I will be spending $100. So I make 15 bucks on the stock, 5 bucks on the dividend. I pay $100. So my return is only 20%. So in other words, and I'm going to put a red pen here, I am somewhere at this point here. So should you buy the stock or should you sell the stock if you have it? Or what would be the analyst's recommendation here? So analysts will obviously say sell the stock, because based on current market conditions, you should be demanding a 25% return, but it's currently yielding only 20%. So most analysts will recommend a sell. As they recommend a sell, what will happen to the price of the stock? Obviously, the price of the stock will start coming down, coming down, coming down, correct? And where will it stop? So it will stop when the expected return is equal to 25%, because that's what the market demands, correct? So in order to solve what it will stop at, we'll do this. 115 plus 5 minus x over x will have to equal to 25%. So now I need to do a little bit of algebra. 120 minus x is equal to 0.25x, or 120 is equal to 1.25x, or x is equal to 120 divided by 125, and that will equal to $96 at this point. Okay, so at $96, if I can purchase this price, so 20 divided by 96, wait, something is wrong, hold on. 115 plus 5 minus x, x is 0.25x. 120 minus x is equal to 125x. Huh. Wait a minute. Let me see. Oh, I don't solve it in my notes, so let me just get this correct. So wait a minute, 115 plus 5 minus x is equal to 0.25. I want it equal to 25. It's 0.25x. X plus 0.25 is 2x. Oh, yes, I cannot do it because I have the dividend in here. So I will have to, oops, can't solve this problem. I have to give you a much simpler version because I cannot give you with the dividends in there. Hold on a second. So let me just think for a second. It will come down to, let's see, 98 plus 5 by 15 minus 98, 5 divided by 2, 6. Wait a second, 105 minus 96. Plus 5 by 96. Oh yeah. Shoot, I'm getting slow at my old age. Really, it's terrible. I was correct all along. 96 is the right price. And why is 96 the right price? Let me make it very clear. So basically, if you bought the price for $96, right? If your price is 96, then let's see what your expected return is. You buy it at 96, at the end of the year, you sell it for 115. What's your return? Your return is 115 minus 96 is what you get for your stock, but you have your $5 return. So that means, and then you paid 96 for it. So your profit is obviously going to be $19 plus 5, $24 over 96 is equal to 0.25. So yes, the stock price will continue to come down. I'm going to do another example, so don't worry. It'll continue to come down so that when it hits 25%, the analysts will change their mind and say, now this is a good price, hold on to the stock. Okay? And if it continues to drop, then the analyst will say back again that it's a good buy, you should buy, and then everybody will buy and the stock price will go up. So if it continues to come to 95, 94, analysts will say buy, and then it'll start going back up again towards 96. Okay, so just to play it safe, let's do another example. Okay, this time we'll do IBM stock, and that's the example that's on your PowerPoint notes, where the beta is, let me see if I have one with the beta at 5%. Do I have a beta at 5? No, I don't, but I will do this example so that you don't mess it up. So let's do this. Same 5% security market line. I have a beta stock with a beta of 0.5. Okay? And based on what I learned, my required rate of return should be 0.5% plus 0.5, 0.15 minus 0.10, 0.05 plus half of that. So I should be happy if I can get a 10% return. So I should do it this way. A 10% return. Let's say IBM stock, remember this was IBM, is selling at $100 today, is the price zero. Its expected return is about, they expect to pay a dividend of $2. And the price expected to prevail at the end is about $110. Should you recommend buying the stock or should you recommend selling the stock? So let's see. The expected return, if you paid $100 for this, is 110 plus $2 dividend minus 100 over 100 means you'll get $12 over 100 or a 12% return. In other words, you're getting a 12% return. What do you think most analysts will say? Most analysts will say, hey, if you should be happy with a 10, right now it is giving 12, you should buy the stock. So the interesting you should notice is every point below the SML line, you should sell the stock. Everything that lies over the SML line, you should buy the stock. So this one at 0.5 is giving a return of 12, which is over the 10. So obviously what's going to happen, if everybody says buy, 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 what's the stock price going to do? It's going to go to 100.50, 101, etc., start going up. At what, so that means the expected return will start coming down the more you pay for the stock. At some point it will reach here and analysts will change it to say a hold. What is that price going to be? Well, we do the same thing. We say 110 plus 2 minus x over x should equal to 10%. So 112 minus x is equal to 0.10x. 112 is equal to 1.10x, or x is equal to 112 divided by 110. Let me do that. And it should be $101.82. So when it reached $101.82, your expected return should be 10%. Let's check it out. If I can sell at the end of the year 182 plus my $2 dividends over 100, what do I get? I get 101.82. Should it be exactly equal to 102? Why am I not getting this perfect? Move that to 110 divided by the dividend is 2. Hold on. 101.82 plus 2 divided by 100. Okay, so I'm going to do another example, another diagram here again, as I said. So let's start with this. Let's say I redraw the line for the security market line, SML, This is 0.05. On this axis is the return, and on this axis is the beta. Let's start with the stock with a beta of 2. We said if you're going to buy a stock with a beta of 2, then you should be demanding a 25% return. Let's put this all in percents here. So 5%, 25%. And how did we get this? Well, we said, listen, if I use the security market line, RI, it's 5% is the risk-free, the beta is 2, 15 is the expected return, 5 is the risk-free rate, so it's equal to 0.05 plus 2 times 10, so it's 20 to 25%. Now let's say you have a stock, this stock, let's say Chevron. Chevron stock right now, the price today is $100. It expects to pay a dividend, so D1 of let's say $5. And most analysts think at the end of the year, the stock will be selling for about, let me see, let's just make it $115. Okay. So will this price, would it be worth buying this stock? So for that, let's see what our expected return is or what the market is expecting to get. So the expected return is, remember new minus old over old. So at the end of the year, I'll get a price of 115 plus $5 dividends. I'll pay $100 upfront. That means my profit, 115 plus 120, minus I'll make about $20 in profit over 100, and I'll therefore get a 20% return. In other words, for a beta of stock here, I am just about here. Is it worth for me to buy the stock? The answer is no. In fact, analysts using this model will basically say sell the stock, because the required return for a stock of this risk should be 25. It's only generating a 20% return, so return the stock. So what happens when people sell the stock or the analysts recommend the stock? What will happen to the price of the stock today? It will start coming down. And as it comes down, it's a good deal, correct? So your expected return will go up. And so it will start going up, going up, going up till it reaches here. But at what price will it be in equilibrium? Well, that's easy to calculate because all we do is this. We say your expected return should be 115 is what you'll get, plus $5. What we want to know is what should we buy today? Let's make that X such that it becomes 25. So if I were to solve it, let's say 120 minus X is equal to, bring this X over here, 0.25X, or 120 is equal to 1.25X when I bring this 1X here. X is equal to 120 divided by 1.25 is equal to $96. So if we could get the stock at 96, let's see what our expected return is. At 96, let's see, my expected return is, I get 115 plus 5 minus 96 over 96. In other words, I make $20 over 96, and lo and presto, it's 25. So when it hits 96, the analyst will change it into a hold, because this is a good price as per the capital asset pricing model or the security market line. So what we say is when all stocks are below the SML line, we consider them as overvalued, and you should sell the stock. Now let's do an example where it's the other way around, when the stocks are lying above the SML line. So let's do that with an example of IBM. Okay. So let's say I could do it in the same diagram there, but it'll be cluttered. So we figured out that when you have a beta of 0.5, you should demand a 0.10% because Ri is equal to 0.05 plus 0.5 is the beta, Rm minus Rf. So that's equal to 0.05 plus 0.5 times 10, and that's equal to half of that, so 0.10. So if we can get 10% from IBM, which has a beta of 0.5, we should buy the stock. Let's say currently the price of IBM is $100. They plan to pay a dividend of $2. And we expect the price at the end of the year to be $110. Should you buy or sell the stock? So let's see, the expected return is equal to 110 plus 2 minus 100 over 100, which means you'll make $12 over 100, so you're getting a 12% return. 12% return. Obviously, you are over here. Your required is 10, you're getting 12. What will you say? You'll obviously say buy the stock. So as more and more people buy the stock, what will happen to the price of the stock? The price of the stock will start going up, up, up. How high should it go? Well, we know 110 plus 2 minus x over x should hit about 10%. So if I were to solve this algebraically, it'd be 112 minus x equals 0.10x. 112 is equal to 1.10x. X is equal to 112 divided by 1.10. It'll be equal to $101.82. So in other words, from 100, it'll keep going up till 1021. The expected return keeps coming up so that at 101.82, the expected return is 10, which is equal to your required return. Let's check if that number is right. I'll get 110 plus 2, and I'll pay 101.82 over 101.82. That's my return. Or I'll make $12 over 101.82, which is exactly equal to 10%. So you say, okay, 101.82 is a good price. So if any stocks is lying above the security market line, we say it's undervalued and you should buy the stock. Okay. Now I've covered here a whole section on CAPM. I've just chosen the very simple concept and in terms of giving a brief idea of what the CAPM model is, okay? But that's sufficient for this class. And therefore, I think if you know how to calculate the standard deviation and the portfolio standard deviations, and then just do the security market line, understand the principles of what it means when it comes to valuing stock, that's more than enough for chapter 13. So thank you all, and I'll see you in class.